Good morning, guys. September 3rd, 2019, Tuesday. Let's rock. Here's what we got going on. Def hook is actually forming. Yes, I know nobody's talking about it, but overall on S&P 500, we identified there's a high probability of a def hook forming. As you know, most of the def hooks actually do end up in def crosses, which puts us in a very similar situation compared to that of October, November, and December of 2018. So big drop basically in the next 60 days. We're going to break the chart down in just a second. Now, Magic 2931 works again like magic. We're going to take a look at that as well. Asia down, Europe down, oil down, dollar up. Guys, those are exact conditions that were dominating the headlines just about 11 months ago before the big downward swing in the markets. Now, the fact that dollar's up and Brexit definitely hurts the euro, and the uncertainty of the Brexit headlines surfacing again. It's actually a negative for BKNG. So at some point this week, we may be considering BKNG put. We will be sending out the message to the group at some point. So lucky numbers for this week, guys. Write this down: 2931, 2920, 2889, 2872, 2852, 2820, and 2775. Okay, possible trades we are looking into this week is PANW, BKNG, Workday, Alexion, and SRPT again. Man, that chart looks bad. I just can no longer just look at it. I may have to take some action on this thing again. Now, with that said, guys, we're not looking at trading today like wild men. There's actually just too many probabilities, possibilities of what the market could do. So today, trade small. Don't go crazy unless we get to this 29.31 level on a bounce, which we do believe the bounce is coming right as the market opens. The market is going to try to move higher, trying to close this pre-market gap that was created. Basically, the way you incorporate these numbers into your trading routine this week, anytime the market bounces to one of these levels, you want to buy puts. Anytime it goes close to the next level, you want to collect profits, not with the entire position, but let's say you take a third or half of the position off, just in case that next level is not breached. If it is breached, you basically get back in with a higher position. And basically, that's how you use these levels, guys. It's nice and simple. If you do that, your job is very, very easy. So let's take a look at this def hook, guys. I know it's tough for some guys to use the imagination, but I really need you to on this one, guys, because a lot of times when these def hook formation, def cross formations are going to take place, it is going to be kind of late to get into this trade. So what we've got so far is this magic number, right? This 29.31. So we've identified it the very first time we've posted a video a few weeks in the very early of August. We said 29.31 is that number. Anytime it gets there, short the market. So since then, it happened 1, 2, got very close to it right here, 3, 4, 5 times. So 5 times gives you a very high probability that if we are going to get to that number again, that creates a very, very solid entry on the put side, not on the call side. So there was some concerns that we voiced in the video on Friday that said, hey, if we see a huge volume increase, then it makes sense to wait and see if that level is actually going to be finally broken to the upside. But it actually had an opportunity to do so, and it failed miserably, which puts us, the longer we stay under this blue line, guys, just remember these basics rule of thumb that could help you in your trading. The basic rule of thumb is the longer we stay under the blue line, the higher the probability of the market going higher, because basically it tells you as soon as we get to this level of 29.31, there is a lot more sellers rather than buyers at these levels. And so until we're going to get more buyers rather than sellers, that level will not be broken. So it makes it for a nice, sweet level to short every time we get there. Now, as indicated, there was a couple of times we didn't quite get there. We got close, 29.20, 29.25, 29.28. So that's why you don't want to wait till we get to this level to short. So if we get to 29.15, 29.20, start stepping into these positions in the expectation that, yes, it could still easily go higher to 29.31. But just in case it doesn't, you already got that position. And if you see a clear reversal, like an example right here between these two candles, then you can easily add some more position when you see the reversal lower develop. But you don't want to miss this entry is closer to the top level between 29.15, 29.20, and 29.31. All these areas are good areas to come in and actually buy some puts, buy some directional puts. Now, with that said, we think that the next part of this development on the chart is going to be this curve in the blue line, and if this line curves, the orange line is not necessarily going to go higher, it's just going to kind of stall out there. So all we're going to do is see more of a move on the blue line side coming closer to the orange line. Well, this is what we call a death hook. Death hook is a pre-existing condition for a death cross. And the death cross, basically estimating this death hook to develop, it's going to kind of look like this by September 27th. And in order for that to take place, guys, you are going to see the market going back to this 28.50 level, 28.25 level for this line to actually form this. Now, the actual death cross, we believe, could easily take place by October 25th. And you may be thinking, well, hold on, you're saying we could actually go all the way down to 28.20 or 27.75 this week, so why wouldn't the death cross not develop all the way to by October 25th? To where we actually get the cross. Now, the cross, for those of you that don't know, is in pre-existing condition to where once we do get the cross, there could be, a 10, 20, in some instances, some rare instances, a 30% drop. Now, in some individual stocks, if we match this cross, the drops could be bigger. So let's say if the overall market dips 10%, some of the particular stocks could drop to as much as 20, 30, 40% in some instances. So, but just overall, guys, what we're talking about right now is the direction overall where the market could be heading over the next 60 days. So we're expecting this cross to form by October 25th. Why? Because just as portrayed very nicely in the trading action for the entire month of August, been trading in a range, and the clear characteristic of that trading was on these down days, the volume has been substantially higher than the volume on the up days. Okay, so, but nonetheless, there were quite a few up days throughout the month where, you see all these white candles, all these gap ups higher. So don't expect the market to just continuously drop in straight line. Therefore, don't underestimate the actual time frame for these conditions to actually take place, where initially we get this death hook followed by a death cross, which is going to give us a really nice setup for a further drop overall in the markets. But we are going to be targeting, using these observations, some specific stocks. So pay very close attention, guys. The situation that we're looking at basically is almost identical to the environment of that October, November, December 2018. This time it could actually initiate and begin in September. So watch for the oil to drop below the $49 mark. So last year, they didn't talk a whole lot about it. The oil just kept dropping and dropping, and we estimated that that was actually one of the main reasons that initiated the drop. So oil is down pre-market, and it's around $51 mark. So we're not very far from this 49 level on oil, and if that level is bridged, guys, oil could drop all the way to like 40, 42, and if that's going to be the case, that's going to be a huge catalyst for the markets to go lower. And the second condition that was developed at the same time last year, before all these big drops developed, was the strong dollar. So let's take a look at the chart of the dollar and see what's actually going on. So despite of all the odds, despite of a lot of analysts saying, well, dollar is going to drop because, everybody's putting their money in gold, and actually dollar should be dropping, but it's not, because you have to put everything in the context of comparison to what's actually happening worldwide. And so when you got these Brexit fears, it creates a nice catalyst for the dollar to go higher. Considering that it is just breaking out in the last couple of days out of this nice bullish cup with a handle formation, this was actually the buy point on the dollar at about 98. So from this cup with the handles, hey, it can easily go another 5% higher from here. We could see dollar at like 103. With that said, that's actually a very negative catalyst to all the companies that are doing business overseas. For example, BKNG, it does a ton of business in overseas, so when it's going to report earnings here in the United States, the earnings are going to look substantially lower, because actually BKNG makes a lot more money overseas than it does here in the United States. So what happens, basically, anybody that's pricing their vacation in Europe, okay, since they're paying for their travel in euros. Now all of a sudden they have less buying power to order stuff on Priceline websites, so they're going to go with local websites in order to not take a hit for this currency depreciation that they're going through right now. So on one side, it does impact Priceline sales. On another side, it impacts Priceline reporting when it does convert all the sales it does back into dollars to report its earnings. So this could be a catalyst that some institutional investors could be looking out for, and that could be the reason for them to actually start selling BKNG shares. Now, with that said, we're not necessarily looking to short BKNG today. We will keep an eye on it, and we'll send a message in the group so you guys can take advantage of it. Now, you may think, Leonardo, hold on. Last year, the market was dropping because of the fear of the rates increase, but now the rates have fallen. So the answer to that, great observation if you're thinking that. However, this is what's going on now. So economic data is not as strong as it was a year ago. Okay, the market fear now is being replaced with a fear of not enough cuts. So especially when you combine that with the trade war, and it doesn't really matter. The trade war resolution does not really matter at this point. I mean, clear any escalation and deterioration in trade talks will provide an extra leg down for the markets. But even if we show improvements, the damage to the U.S. companies has already been done. Just think about how many contracts China has signed with Brazil and Russia and other countries and replaced United States as either a customer or for the products that United States was selling to China. All of a sudden, China is not buying them from US anymore. They're buying it somewhere else. So whether Trump realizes this or not, the damage has been done, and this damage is going to show when these companies are going to be reporting their next few quarters. Now, institutional investors don't buy this story. Now, got some smart guys running institutional funds, but I'm actually going to take the opposite side of the equation. I think that this temporary spike in institutional buying activity in the retail stocks is not going to end up well. I think we should use this as a buying opportunity to buy puts in these retailers as they're going higher. Prime examples would be Tiffany. There's no damn reason to be buying this stock. It's a dog, okay? But yet, there's been substantial buying. Now, substantial buying in Tiffany could be explained by the fact that maybe one fund had just too much money tied up, and if it allowed the stock to get an instant drop, let's say all the way to the 60s, that would have taken some huge losses. So they may be just temporarily supporting the stock at this level, but ultimately Tiffany is going lower. And I'm just using that as an example because it was one of our recent trades. The stock will be heading lower. So when the president of the United States tells you, hey, hold on, I'm going to slow down in the tariffs because it's going to impact U.S. consumer for Christmas, well, number one, he's actually acknowledging that his tariffs are a negative thing for United States consumer because the prices have been steadily going higher, okay? Now, it is going to be offset slightly by the dollar buying power moving higher. But overall, I think we are heading into a very crazy Thanksgiving Christmas type shopping activity, and the markets could be highly disappointed. So as all these retailers are moving higher, that is actually our top 3 sectors to short going into Thanksgiving season. Guys, please pay attention because it doesn't mean we're coming out and we're shorting these stocks today. Okay, this is just an overall idea to pay close attention to, and when we are choosing particular stocks, we will disclose them in these videos. Just keep in mind that the spike in the retail sector is actually an opportunity to short. Now, history shows that the first rate cut or pause is good after a cycle of increases. Now, 2 or more rate cuts is actually bad. So, September Federal Reserve cut could actually cause the markets to drop, and this could be the catalyst to actually get us to a death hook and a death cross formation on the S&P chart. So with all this bear talk, guys, this morning, beware. Stocks are down on low volume, which gives us a higher probability of a bounce when the market is actually going to open higher. So be smart when you're buying puts. Don't put any crazy positions today because the market just could be wobbly between 29.20 and 29 100 level. So you don't want to be stuck in somewhat of a just sideways trend here. I would rather much see you guys take advantage of some of these trades, like in particular PANW. I think that's going to be a great trade. It's announcing earnings tomorrow after hours. We will be going over the trade in detail either tomorrow or Wednesday morning before we actually going to place trades on it. So don't buy puts at the bottom. Focus on buying puts on bounces. So as far as the bounces, we're expecting a bounce after the market opens to 29.15, 29.20 area. So far, at the moment I'm recording this, the market is trading at 29.03. And so when the market opens, we think it's going to touch this level of 29.15, possibly go to 29.20. With the best possible outcome for entries, it could jump to 29.31, which would be the ultimate entry point. With that said, I think the volume is going to subside and the market is going to drop once it gets to these levels. So in the last video, we pointed out that we are on the edge of this trading tunnel. So far, we have fallen off that edge and appears to be a good, reasonable bounce back, trying to recover this pre-market gap, which ultimately will fail and result in follow-through on the drop side. Yesterday's, guys, market move, not yesterday's, but Friday. We had a long weekend with this Monday being off. So August 30th, guys, we had a easy move too. This is how it looked on the chart. So initially, the market showed like they were wanting to go higher, and then as soon as they did, the sell-off began in the early part of the day. By 10:30, 10:45, we started seeing some clear signs of a sell-off. Market rebounded, tried to stage a rally, another smaller sell-off going into the close, but a much bigger volume. Also represented confirming this accumulation distribution, so more people were getting out even though we didn't get a huge drop. So oftentimes when you see a condition like that, that is actually going to be a preceding condition to a bigger drop that will happen the next day. Therefore, that's why we're sending a ton of messages to be buying puts all day on Friday, basically in the second half of the day. So the 2-day sequence is 7-2, guys. Got bulls and bears fighting again. 7 is a big institutional buying activity. 2 is a big institutional unload and selling type day. So you got a 7-2 combination. We think there's a higher probability of the markets after they fail to close the gap to reverse and go lower. With that said, this sequence overall right now is 7-2, 8, 7-2. And pointed out on Friday, we could have had a very powerful sequence 8, 7, 7, but instead of a 7, we got a 2, which basically killed a very bullish sequence. But expect the bulls to still be somewhat active. Therefore, don't expect the market to crash today or tomorrow. Just expect the market to slow, pop, and fade and work themselves lower. Pop and fade and work themselves lower. Possible head and shoulder developing on this 5-day sequence is pointed out by a series of dots. These dots right here, guys, they represent a spike in volume when the markets are actually dropping. You see a substantial volume increase, and throughout the day when the market is trying to climb higher, we've got a decrease in the volume. So this resembles a head and shoulder pattern, so maybe we're going to have another mediocre day, just kind of moving sideways a day or two before a bigger drop is going to develop. So next market move, with the failure of this bullish sequence on Friday, we actually have a high probability today of a move 11, which is a pyramid that's going to be in the negative territory, and move 3, trying to close the gap and failing and moving lower, and a very low probability of a move 8, where if after the open, Trump decides to send some crazy tweets saying, hey, you know, we're buying Australia, or we're doing something crazy, and you know, the chances of that happening are not good, but let's not discount the fact that it could take place. A crazy Trump tweet could temporarily move the markets higher. Therefore, we want to avoid trading with big positions today. With that said, guys, VIX had a down day on a Friday. Overall, a move higher but lower in relation to the previous day. Opened at 17.32, went all the way to 19.26, closed at 19, so closed at the highs of the day. VIX is above 16, up trading. You guys know what to do there. If you don't, guys, review the 13 Markets Move Formula course. It definitely tells you specifically what you should be doing here. Okay, VIX holds 1920 level firmly, and please do not, okay, buy puts at the open. Wait for a bounce. The bounce in the market after the open within the first hour of opening is going to coincide with VIX closing this gap lower. So once VIX closes this gap, this is going to provide you with a much better entry point because it's going to discount the valuation of the put options on the market. So key takeaways: wait for a bounce after the open, short the market around 29.20, 29.31 level, add more puts if the first two lucky numbers levels are broken, 29.05 and 28.89. Target drop, your first drop to take profits at 29.05, second level 28.89. Guys, get ready to rock this week. Some cool earnings are coming up in the next 72 hours. Trade wisely and lock some healthy gains. With that said, I'll catch you on the next video tomorrow.